In this video, we learn about the balance of payments. Balance of payments is a statistical record of international transactions over a certain period of time. So first of all, we need to understand why we need to see the balance of payment at all. Balance of payment, in very simple terms, is all about determining the demand of a country's currency and the supply of a country's currency. So the balance of these two determines where the currency's exchange rate actually lies. So if we see it over a time, balance of payment data can shed light on important developments in a country's comparative advantage and international competitiveness. So for instance, if we see, like we'll get into the details later, but if we see that India is exporting a lot more cars than it is importing, so we would know that India might have a competitive advantage in the manufacture or the selling of cars. Similarly, we can know which country has a competitive advantage in manufacturing, in services, in agriculture. So we get to know a lot about a country's competitive advantage using BOP. Balance of payment accounts consist of three basic pillars. First is the current account, then the capital account, and the third is the reserve account. Current account is basically a record of flows of exports, imports, investment income, and international financial transfers. So these are like you have a current account, your own current account. So these are things which are flow in nature. So in a year, you'll have certain exports, you'll have certain imports, and if you have invested in certain, let us say bonds or whatever, you'll get interest income. So it is income. And also international financial transfers like remittances. All these come under the current account. Contrast that with the capital account. Capital account, like the three major ones, are FDI. FDI is foreign direct investment, which is acquisition of controlling interest in foreign businesses. So you might have heard that some company comes and buys a 26% stake in an Indian company. So that company is providing FDI to that Indian company, foreign direct investment. So this, like contrasting it with the previous concept of current account, where the current account entity thing was for a period of time. So exports are so and so during 1 year. But FDI, when it comes, it remains for a number of years. So it's not really, it might come in a particular year, but it will remain in the country for a longer period of time. Its sanctity, its meaning is for a longer period of time. Then the second capital account entity is portfolio investment, where a company or individuals come and invest in foreign shares and bonds, but it is not acquisition of control. So it's very minor amounts. So if, let us say, a wealthy individual, let us say Bill Gates, comes to India and buys a few shares, not controlling stake, but buys some shares in Reliance Industries, that will be portfolio investment. Similarly, there can be other investments, which include bank deposits, currency investments, etc. So the foreign companies could decide to come into India and buy a bank deposit, because Indian bank deposits pay a much higher interest rate than the bank deposits in US. So those are the kind of capital investments which come under the capital account of the balance of payments. So the third thing is the reserve account. So the reserve account of BOP records changes in the amount of official reserves held by the central bank. So reserves can be in various forms. It could be in the form of gold, foreign currencies, SDRs, and reserve positions in the IMF. If a country must make net payments to foreigners because of BOP deficit, the country could either run down its official reserves or borrow from foreigners. So in simple terms, what does this mean? Let us say that BCA is your balance of current account and BKA is the balance of capital accounts. So let us say in a country, the current account balance is 0, which means that the exports and other things that we mentioned, exports are equal to imports. So in the net inflows or outflows are 0. But this country receives a lot of foreign direct investment. So foreign direct investment comes under the balance of capital accounts. So there are a lot of foreign direct investments. So what will happen? These foreign direct investments could get accumulated in a reserve account. So this is how this equation gets balanced. But does this mean that every country needs to have a reserve? Because the current account and the capital account will not always necessarily balance. Most countries will have certain balance in the current account, which means they would either export more than import or import more than export. And similarly, they'll have a balance on the capital account. So now we come on to answer this question. We'll see that there are two systems running in the world. One is a pure flexible exchange rate and one is a fixed exchange rate system. In case of a pure flexible exchange rate, what happens is if you have a balance on the current account or the capital account, then the exchange rate would adjust itself so that if eventually these will balance and you do not need to accumulate reserves. One reason why reserves are accumulated is so that you can intervene in the market to stabilize your exchange rate. But if you have a purely flexible exchange rate, you do not require any reserves to manipulate your currency. So most Western economies like US, Russia, EU and Britain, etc. have a purely flexible exchange rate. The second system is a fixed exchange rate. In a fixed exchange rate, let us say we decide today that India is going to have a fixed exchange rate of $1 is equal to 45 rupees. In this case, if we have a balance on the current account or capital account, then there will be excess, let us say more dollars are coming in. There is, let us say, higher FDI or higher exports. So more dollars are coming in. So if the central bank does not buy those dollars will tend to, what will happen? There are more dollars in the economy now. So there is a pressure on the dollar to depreciate, which means dollar is more in supply. So the price of dollar should go down, which means that the Indian rupee will start appreciating. It will start moving away from 45 to, let us say, 44, 43, because it is now becoming stronger because there's so many dollars that the supply is very much high. So in this case, because the government does not want the exchange rate to move, then what they do is they start buying all those dollars and start storing it away in this reserve account. So they actually effectively just remove all those dollars from the economy and put them in a safe, let us say, shelf, and which is called the reserve account. So that is how you can understand these two systems. There is also somewhere in between which is called a managed float, where your exchange rate is not exactly flexible, but it is not exactly fixed. But that is some slight more detail, so we'll skip that. So let us just take an example. In case of China, what is the balance of current accounts? It has huge exports, so balance of current account is in surplus. What is the balance in capital accounts? Again, China attracts a lot of FDI, so balance of current account is also in surplus. And as you may have heard, China is not a free floating currency, so these extra dollars are accumulated in that safe shelf that I told you. So the reserves keep building up. Like here is mentioned, there is an increase in the reserves because dollars are coming in, we stash them away, and that becomes the reserve. Now, assuming there are no reserves, what is the impact on currency if there is a surplus or deficit in the current account or the capital account? Let us take this case. If there is a surplus in the capital account, again, what does this mean in very simple terms? This means that there is a lot of FDI and FII and other investments coming into the economy. Any money coming into the economy in whatever form, let us say take the example of India itself, means there are dollars coming in. If there are dollars coming in, it means the supply of dollars is higher. There are dollars everywhere. So if the supply of dollar is higher, you would expect the dollar's price to fall because the supply is higher than the demand. So which means our currency, that is Indian rupee, will appreciate. So similarly, if there is a deficit in the current account or the capital account, which means that we are importing a lot more than we are exporting, which means there is a deficit in current account. So we keep importing. So what will happen is we need dollars to buy the foreign products. So all the dollars that are there in our economy will start going out from wherever we are buying the product from. So if dollars start to go, or similarly, why would the dollars go? Another case would be that we are doing FDI in other countries, or the FDI that had come to India is going away for some reason. In all these cases, there is lesser supply of dollars relative to the demand, which means the demand is higher than the supply of dollars, which means the dollar's price should rise, which means our currency effectively weakens and the currency depreciates. So after all this, you should be able to basically understand if there is a positive current account balance. So is it a good measure of economic health? See, current account balance and all these balances are only one part of a big jigsaw puzzle. So if you have a positive current account balance, it only means that you are exporting more than importing. So that is not really a cause for very great celebration. In fact, it is said that current account deficit up to 2% is sustainable in India. So which means we can import up to 2% more than what we are exporting. Why? Because India gets a lot of FDI. So what we eventually need to do is to make sure that there is no flight of capital and there are no unsustainable pressures on the economy or the currency. So this is not really a good measure of economic health. Similarly, is the net inflow of capital bad? That is not necessarily true at all. If it depends on in which form the capital is coming. If capital is coming in the form of FDI, which goes into our infrastructure projects and it helps us build roads and bridges and dams, then obviously it is a good thing. But if all the money is coming and it is getting invested in real estate, where the prices are getting increased artificially and eventually the bubble would burst, like what happened in 2008 in the US, then obviously net inflow of capital is a bad thing. So what we mean to say is there is no straight-jacketed approach of saying that this is good and this is bad, and there is no one prescription for every country. To understand the economic health of a country, you need to understand the breakup of all these things, of the balance of payments and other economic parameters, to understand how the country is doing. That's it. Thank you for watching. Hope you liked the video. Comments and suggestions are welcome. Thank you.